Hi, and welcome to the show. Subscribe at kevinmd.com/podcast. Get CME for this episode by clicking on the CME link in the show notes. Today, we welcome Scott, Kyle, and Patrick Fischer. They are authors of The Compound Code, an expert guide to trading stocks and options. Scott and Patrick, welcome to the show.
Thanks for
Thank
having
you
us.
so much. Pleasure to
All
be
right.
here.
So I'm going to ask each of you to just briefly share your story and journey, then we'll jump right into your book. Scott, why don't you go first?
Yeah, Scott Kyle here. So I grew up in the Midwest, went to school in Boston, and eventually made my way to California. While I was in school in Boston, I met actually Warren Buffett, who inspired me to become a financial advisor. I really liked the way he thought about investing, keeping things simple, really focusing on high quality businesses. So I started my career here in La Jolla, California, and I've been a financial advisor for the last 25 years.
All right, Scott, let me ask you, we have an audience of clinicians here, and I'm sure that you have some clinicians as part of your clientele. What are some of the most common questions that you often get asked from that clinician clientele?
Sure, we do. Yeah, we actually have a lot of doctors. And so the way I look at it is that if I broke my nose or arm, I suppose I could probably spend a couple years studying how to fix it, but I'm probably better off going to someone who's an expert at what, he or she does, who has decades of experience. And so similarly, when it comes to managing money, we often don't know what we don't know and or don't have the emotional makeup to stay on track. I've never been very good with blood, so I know I wouldn't be a good doctor, but my brain is very much wired to manage money and to help you with their money. So really that the most important thing to talk to clients about and for them to ask is, what are our goals here? What's the purpose of the money? Do we need it to pay the mortgage this month? Do we need it to fund our kids' college in 10 years? Do we need it for retirement in 20 years? And to basically ask those key questions, just like with health. What are my health goals here? To lose weight, to improve my heart, etc. And then set a plan to achieve those goals. And then, of course, monitor that on an ongoing basis.
All right, and Patrick, just briefly share your story and journey to where you are today.
Sure. So unlike Scott, who's a Midwest kid, I'm a California kid, and I actually met Scott when I was an undergrad at UC San Diego studying math. So my first job out of college was actually with Scott at the predecessor to Coastwise, which was a hedge fund. So we've been friends and colleagues for over 2 decades. After spending nearly 10 years on the institutional side, I came back to the wealth management side to rejoin Scott at Coastwise. So it's very much a homecoming for me.
All right, and Patrick, again, among your clinician colleagues, and I'm sure that clinicians make a lot of mistakes when it comes to financial management. What would you say is the biggest mistake that you see physicians make when it comes to wealth and asset management?
Oh, Kevin, that's kind of a loaded question, but what I'll say is I think I think that whether it's a clinician or someone who is very scientific, I think that some clients and some investors have a tendency to overthink things and also have a tendency to try to do something when sometimes the best thing is to do nothing at all. And so I think it's more important when you're looking at investing and you're looking at whether it's a specific position or your financial plan. As Warren Buffett says, it's better to look for the haystacks than the needles in the haystacks. And to really just sort of know what you're trying to do and look at the long-term goals and make sure that you're making progress towards that and not try to always do things and tinker from day to day, because then you can end up chasing your tail.
All right. And when you say tinkering, what's an example of that? Well, what do you see physicians do when it comes to like tinkering, when it comes to some of their financial plans?
I think when it comes to tinkering, it's consistent with the clinician space as well as others, is that people will hear things on the news, they'll read something in a journal, they might talk to a friend who has a position and maybe they're also a clinician, and so they take advice from them there. It's just a tendency to want to do stuff when nothing needs to be done.
All right. So let's talk about the book both of you wrote. It's titled The Compound Code, an expert guide to trading stocks and options. So Scott, tell us a little bit about the book and how it came together.
Sure. Yeah. So I've been investing for nearly 40 years and a professional investment advisor for over 25 years. And so during that time, I've both made a lot of mistakes myself as well as witnessed others, our clients as well, either do something that could have been a mistake that hopefully we keep them from doing, or just making mistakes outright. So while it is incredibly satisfying to be servicing our several hundred clients that we do around the country, it's nice to be able to communicate the lessons that we've learned as advisors and individual investors to a broader audience. So I've written 3 other books, and then I asked Patrick to join me to write this book. So we spent basically the last couple of years putting down on paper all the things that we've learned over several decades so that we could share that with a wider audience.
So, Scott, I hear a lot of clinicians, especially in these physician financial Facebook groups, that they, as you know, don't get a lot of education when it comes to financial literacy. So go to the very basic. So if a physician, say, comes to you and say, please manage my money, where would you direct them to? What was the first thing that you would start them out with?
Yeah, again, like if you were to go in to get a health checkup, the first thing to do is basically to get some basic information. Where are you today in terms of your assets, your liabilities, your cash flow? Because quite often, even people who are extremely good at what they do in other fields, they aren't always organized when it comes to their financial life. So make sure that they're well organized, they have a clear picture where they are today. And then, as we talked about before, talk about what their goals are going forward and what their needs are going forward. Because really the process of investing is to satisfy future needs. Those needs might be 30 years down the road, or there might be 3 days down the road to pay a mortgage. And so when you connect where you are today with where you want to go, now things will always change. Things will come up, just like with your health. You may break an arm accidentally. And so we need to adjust for those changes. But having a clear sense of where you are and a plan for the future is really the foundation for any good investment program.
And Patrick, as it relates to your book, just tell us some of the main points from your book that would resonate with a clinician audience.
Yeah, I think to Scott's point, I think one of the most important questions that you want to ask yourself is, when do you need the money back? And that's sort of a basic financial planning question, because from there, you're going to get a sense of how much of the money should be invested in stocks versus bonds versus perhaps paying off student loans if you're, sort of a newly minted doctor. And then from there, once you get into security selection, you can start to look about things like dividend-paying stocks and using covered call options to generate income, particularly if you're later on in your career and you're looking to generate income with the portfolio.
Give us some scenarios that you commonly see physicians come to you with, and in terms of stocks versus options, where you would start them in terms of asset allocation. Just take us through the basics and maybe walk through a couple of could be real or hypothetical scenarios that clinicians would commonly come to you with.
Sure. So I would say that a clinician could come to us with a scenario where perhaps, salary is probably pretty good. They might have some student debt that they need to pay off. So they need to sort of allocate money towards paying off student debt. And they're really looking to us to help manage and optimize, from a financial planning perspective, how to allocate the capital. So once we've sort of figured out how to do that and how much to put down on a monthly basis to pay off the student debt, or it could be a mortgage or something like this, it's really a function of how long do you plan to work versus when should we start to look to replace that income with call options and dividend-paying stocks. And so I think that's a very common scenario where we're really looking to make sure that we have the time horizon appropriately set so that we can make sure that we can allocate capital ourselves to replace the income that they'll need when they retire.
All right. So, Scott, your book is about both stocks and options. A lot of my audience may not know what options are, so just give us kind of a primer on what exactly an option is.
Sure. So options really serve a few different purposes. Just like in surgery, a knife can be dangerous if in the wrong hands, or it can be life-saving. So options can both be risky and can be used in a very conservative way. We use options in the latter way, the conservative way. So what purposes do options serve? They can, as Patrick mentioned, they can serve to generate lots of income. They can also serve to reduce portfolio volatility, so may make the ride less bumpy, and also they can provide some downside protection or hedging. So a basic example is what's called a covered call. A covered call means you buy a good stock, Pfizer, Abbott Labs, Coca-Cola, whatever it may be, and that stock in of itself could pay a dividend, so it could be a source of income. Most dividend-paying stocks pay dividends every quarter or 90 days. And then what you do is what's called sell a call against that stock. So let's say Coca-Cola is trading at $60 a share, and you may sell a call at $65 a share, which expires in 6 months. In selling that call, you immediately get cash or the premium credited to your account. So it's an immediate form of income or cash to your account, which you can then reinvest in a money market or fixed income. And then if the stock stays below 65 before time of expiration, which is in this case would be 6 months, then the option expires worthless, which sounds bad. That just means that you collected all the premium, and then you could sell another call for additional premium. Or if the stock rises above the strike price, in this case, $65 a share, then you'd be obligated to sell the stock at 65. But going into it, you'd be perfectly happy selling at 65, because between the price going up from 60 to 65, plus the dividends you collect, plus the options premium you collect, that'd be a very satisfactory. That could be a 15 or 20% annualized return. So it's just a way of saying, I'm willing to give up a little bit of upside in exchange for having more downside protection and very steady, reliable income.
And Scott, what part of the financial life? So, are we talking about early investing? Are we talking about investing later on in life? So, I guess in the spectrum of where a physician would be, when should they consider options as part of their investment portfolio?
That's a great question. Yeah. So while we do have decades of experience using options, options aren't right for everyone. They're a tool to fit a particular circumstance. So let's say you have a very long time horizon. You're a new clinician and you have a retirement account. You're in your 30s, 40s, maybe early 50s. You're looking really more to grow that account. So there'd be no reason to use options because you don't need the income from that account. That account is really meant for your future self, 20, 30 years down the road. But there are other scenarios where you need income, either to cover existing expenses because your income doesn't satisfy your expense structure, or you're living off your assets. So for example, we have a doctor who sold her practice, generated a nice nest egg, but then she decided to retire. So unfortunately, even though interest rates have gone up, they're not high enough to generate enough income to support her lifestyle. So by buying dividend-paying stocks and then selling calls, we're able to generate double-digit income for her to allow her to pay her bills. So really, the bottom line is that the use of options is typically best served when you need additional income to satisfy your expenses.
And the only thing, Kevin, that I would add to that is that the other piece about options is that each options contract represents 100 shares. And you wouldn't want any individual position to represent more than a few percentage points of the overall portfolio. So you need to have a certain asset base in order for options to make sense as well, because otherwise you'd end up with 100 shares of one stock in the portfolio. And even though it could be a great options position, you're not diversified from a portfolio management perspective.
So, Patrick, I wanted to ask you your approach to picking stocks, right? So obviously there's a spectrum, individual stocks all the way out to kind of total stock market index funds. And
Yep.
when you read a lot of these finance groups that physicians read, sometimes the most simple thing would be just to kind of use one of those total market index funds. So just tell us your basic approach that physicians should know about when it comes to equity allocation.
Yeah, sure. So on the equity side, there's no hard and fast rule, but I think generally speaking, if the portfolio is sub $300,000, roughly speaking, you might be better served being in ETFs or index funds because you're able to get a broad diversification, whether that's something like SCHD, which is Schwab's dividend-paying ETF, or it's something as simple as SPY, which is the S&P 500 index. Those are great solutions for someone who is still building up their asset base. When you get to a portfolio that's, say, north of $500,000, that's when you can start to think about looking at individual stocks. And that goes into the conversation of, are we looking for dividend-paying stocks to generate income? Are we looking for growth stocks? Perhaps the clinician's spouse or partner is already working at someone like a Google or Facebook, so they've got plenty of exposure to the tech space. And so you kind of want to start to think about the overall portfolio of the household when you start to look at individual stocks. So I think, really, there isn't a specific guideline, but those are sort of the rough metrics that we use.
And Patrick, to follow up on that, what's the pros and cons of including those individual stocks once your assets go above a certain level versus just kind of staying in a diversified index fund?
I think that the pros and cons really come down to diversification. So from a diversification perspective, you can't beat having index funds and ETFs. So there's certainly a great solution. Once you start to look at individual stocks, you have the potential to outperform. You also have the liability and responsibility of doing the research, knowing the positions, following the positions. But again, I think on the plus side is that once you have individual stocks, you can find liquidity in and trade call options to generate income.
All right. So Scott, tell us the type of physicians that should be managing their money themselves. And I know that you guys are biased in terms of looking for a financial advisor, but there are some questions that physicians can ask themselves to determine whether they're the right personality and mentality to manage their money themselves versus engaging with a financial advisory firm.
Sure. So one aspect of what we do as financial advisors is money management, but really it all starts with the financial plan, because you could have a good portfolio, objectively speaking, but it might not be right for you. right? It might not satisfy your circumstances. Again, I could walk into a doctor's office and they could put me on a treadmill and say, hey, you're going to run, but I tell them, oh, by the way, I'm trying to gain muscle, and in which case that would be the wrong thing, right? So it all starts with a plan. But let's say someone does have a good sense of what their plan is, and now it's time to manage the money, the portfolio within that broader plan. In which case, then, really, like Warren Buffett says, it really comes down to the basics, and that is just make sure you don't make some key mistakes. The mistakes that people make that you want to avoid are not being well diversified. That's why we say start with nice broad index funds, and then as your capital grows, start moving into individual stocks. Also, don't try to time the market. It's so tempting to say, I'm going to dart in and out of the market. There's just no data which suggests that anyone can be successful consistently timing the market. So the way that you mitigate market risk in terms of short-term ups and downs is to make sure that you have any money in stocks, money that you don't need for 3 years or more. That's a rough rule. It could be, longer than that, but because by definition, stocks do move up and down in the near term, although they tend to rise over long periods of time. For money that you need in the near term, you would keep that in cash and fixed income. So it really starts with a plan. Make sure you're well diversified, avoid that mistake. Don't try to time the market. And when the market is down, as it will be, there are corrections, meaning a 10% or more decline, typically about once a year, and a bear market being defined as a 20% or more decline, typically every 3 or 4 years, although you don't know when those are going to occur, but they happen on average. If you have a good plan in place, then there's no reason to sell your stocks, because by definition, that's money for your future self, for yourself in 5 years or 10 years. We so often will talk people off the proverbial ledge of wanting to sell stocks at the very wrong time, in March of 2020 during the pandemic, or in February of 2009 during the Great Recession. And every time, 6 months, 12 months later, not that long, they turn around and thank us for keeping them from making a huge mistake, right? Your future self would not only look back and say, thank goodness I didn't sell, but likely say, I wish I had bought more, right? Because stocks do rise over time. And so someone who's looking to do it themselves, just make sure that you have these basics in place, that you have the emotional makeup to not take action when action isn't called for, and then go about your life. Hug your kids, treat your patients, go for a walk, and don't follow it day to day, because you'll drive yourself crazy. And more importantly, you'll make bad decisions when action is not needed.
We're talking to Scott Kyle and Patrick Fischer. They are authors of The Compound Code, an expert guide to trading stocks and options. Now, I'm going to ask both of you just some of your take-home message, perhaps from the book, that physicians can come away with. So, Patrick, why don't you go first?
Take-home message from the book. I would say that it is never too late to invest in the equity markets or the fixed income markets. It doesn't matter if you are approaching retirement, going into retirement. Even if you're about to retire, your time horizon could still very well be 20, 30, 40 years. And so don't think that you've missed the boat or the proverbial boat, because there's always time to do so. Know what you know what you don't know. And I think as you're looking to start investing, always start with a financial plan.
All right, Scott, tell us your take-home messages.
Yeah, the analogy I would draw again with health is to say, let's say your goal is to lose 30 pounds, and the equivalent goal in the stock market would be to save for retirement in 10 years. If you work with someone or do your own research to know how to lose those 100 pounds in a year, and you stick to the plan, the probability of success is very high. What you don't want to do is weigh yourself every 3 minutes and drive yourself crazy. So spend the time creating a plan, really put that time up front, and then I said it before, but I'll say it again, go live your life, because if you're beholden to every stock price movement day to day, then it doesn't matter how successful you are from a financial standpoint, you're not going to live a happy, healthy life, because the stress associated with following the stock market can really impact your physical life as well. So create a plan, take the time, sit down, and then execute the plan, and do check into it periodically, every 6 to 12 months, but don't obsess over short-term movements in the stock market. It'll really work against you both financially as well as physically and emotionally.
The book is called The Compound Code, an expert guide to trading stocks and options. Scott and Patrick, thank you so much for sharing your time and insight. Thanks again for coming on the show.
Thanks so much.
Thank you, Doctor. Been great. Thank you.